Bismillahirrahmanirrahim. Assalamu alaikum. Viewers, you are welcome to my YouTube channel, Finance Specialist. Viewers, in this video, I will explain important terminologies which are helpful to understand the stockholders' equity section given in the statement of financial position or a balance sheet. Viewers, after watching this video, you will be able to understand the concept of joint stock company or corporations, their types, role of board of directors, types of capital, concept of shares and their types including common and preferred, also the concept of dividend, retained earnings, book value per share, dividend yield and some other terminologies which are necessary while dealing with shares. Viewers, in the next video, I will discuss with the practical examples relevant calculations regarding stockholders equity section of balance sheet. So if you are new to this channel, you are requested to subscribe to this channel and press the bell icon so that you will be notified for the future videos. So let's start our discussion. The first term is joint stock company or a corporation. Viewers, when we talk about corporation, it is a business organized as a legal entity which is separate from its owners, chartered by the state with ownership divided into shares of transferable stock. Stockholders are actually the owners of the company, but they are not liable for debts of the corporation. So in this case, their liability is limited to the extent of their investment in the corporation. A corporation is governed or run by the group of persons called as board of directors. Board of directors are elected by the common stockholders to direct the affairs of a corporation. Corporations are broadly classified into two types. The first one is called as publicly owned corporations. Any corporation whose shares are offered for sale to the general public is called as publicly owned corporation, while a corporation owned by a small group of stockholders, not publicly owned, it is called as closely held corporation. To start a corporation, obviously, a money is required. So the capital, the amount which is used by the corporation is called as its capital or legal capital. So the legal capital is the par value or stated value of capital stock issued. This amount represents a permanent commitment of capital by the owners of a corporation and cannot be removed without special legal action. Of course, it may be eroded by losses. Contributed capital is the increase to stockholders' equity that results from capital contribution by investors in exchange for shares of common or preferred stock, also referred to as paid in capital. So we have a concept of paid in capital and we have a concept of additional paid in capital. A paid in capital or a legal capital is the amount of money which has been contributed by the shareholders in the company. Additional paid in capital is the amount which is over and above the par value of the shares. It is called as additional paid in capital. We can understand this with the help of example. Let's say if one share price is $10 actually, which is the face value or the par value of a share. If the same share is sold by the organization in the market at a price of $15, so the extra $5 received will be considered as additional paid in capital. And normally the organizations, they sell their stock more than the face value of their shares because they have if they have a good standing in the market, then the general public would not feel uh, hesitant to buy the stock of the company at a higher price. So the higher price charged by the company, it is called as a premium. Organizations are subject to double taxation. When organizations they make income, so they are taxed first on their income, and when this income is distributed in the form of profit or dividends to the shareholders, then again it is taxed to the stockholders. So the main problem or the disadvantage of organization like the company form of business, joint stock corporations form of business is double taxation. The advantage is obviously, as I've discussed, it is limited personal liability. It is the concept that the owners of a corporation are not personally liable for the debts of the business. Thus, stockholders' potential financial losses are limited to the amount of their equity investment. The term I started using stockholders. It refers the owners of a corporation. The name reflects the fact that their ownership is evidenced by transferable share capital stock. We have two types of stocks. One is called as a common stock and the other one is called as preferred stock. When we talk about common stock, so it is a type of capital stock that possesses the basic rights of ownership, including the right to vote. It represents the residual element of ownership in a corporation. In case of liquidation, the common stock owners they will receive the residual value, and each common stock has its face value, or we can say each stock has its face value, whether it is common or preferred. So face value is also called as par value or stated value. So it is the legal capital of the corporation, represents the minimum amount per share invested in the corporation by its owners and cannot be withdrawn except by special legal action. Then we have preferred stock. So preferred stock, it is a class of capital stock usually having preference as to dividends and in the distribution of assets in the event of liquidation. In the preferred stock, the dividend is fixed. Their profit percentage is fixed, while in common stock it is not fixed. In case of liquidation, preferred stockholders they will get their share when assets are going to distribute towards the closure of the company, so they will get their share first, but the common stock holders they will get only the residual element of ownership in a corporation. So this is the main difference between them. Within preferred category, we have some more features. One is called as cumulative preferred stock, non-cumulative preferred stock, convertible preferred stock, and non-convertible preferred stock. When we talk about cumulative preferred stock, it means that in case if organization doesn't make profit for a particular year and it makes profit the next year, so the organization will have to pay dividend to its preferred stock of all the years in arrear. So it is called as cumulative preferred stock. Non-cumulative means that the dividend will be given to preferred stock people only or preferred stockholders only once organization makes a profit. So cumulative and non-cumulative, this is the difference. Another preferred stock type is convertible. Sometimes an option is given that preferred stockholders can convert their preferred stock into common stock. Let's say if a price of a preferred stock is 100 and common stock price is $25, so preferred stock might think to convert their preferred stock into common stock. In this case, if they convert, so they will get 4 common stock for each share in the preferred stock. So it is called as convertible. Non-convertible means that preferred stock cannot be converted into common. Similarly, we have another feature callable. Sometimes organizations they will buy back their stock. So if this calling price is given or mentioned on that stock, so it is called as a callable, and the call price is fixed also. It is mentioned on a share certificate. So when organizations when they make profit, they will distribute their profit, and they will distribute in the form of sometimes cash, sometimes bonus shares. So it is called as a dividend. If this profit is given in the form of a cash, it is called as a cash dividend. And if it is given in the form of shares, so it is called as a bonus shares. So here you can see that when we talk about dividends, a corporation's distribution of assets, usually cash, to its stockholders, normally viewed as a distribution of profits, it cannot exceed the amount of retained earnings. It must be formally declared by the board of directors and distributed on a per share basis. The next concept is about dividend yield. It is the annual dividend paid to a share of stock expressed as a percentage of the stock's market value. Let's say if dividend which is received is $10 and the market price of a share is $100, so 10 divided by 100, it will give us 10% yield. So it indicates the rate of return represented by the dividend. The next concept is about book value per share. Viewers, as I have discussed earlier, that the amount collected by the organization after selling the shares, it is called as paid in capital. And sometimes organizations they sell their stock at a higher price, so the shareholders in the market they will pay premium to the organization. The extra money which organization receives on account of preferred shares or common shares, it is called as additional paid in capital. So paid in capital, additional paid in capital, and the next thing which is called as retained earnings. So retained earnings is the amount which is retained by the organizations every year, and it grows with the passage of time. So paid in capital, additional paid in capital, and retained earnings, the sum total, it is when it is divided by the total number of shares outstanding, it will give us this value which is called as a book value per share. Later we will see in the next video that how we can calculate dividends, dividend yield, and book value per share. Here it comes the retained earning. As I have explained earlier, the element of owner's equity in a corporation that has accumulated through profitable business operations. Net income increases retained earnings obviously, and net losses and dividends reduce retained earnings. Viewers, each stock or a share, it is reflected as a certificate. So it is called as a stock certificate. When we talk about the stock certificate, it is a document which is issued by a corporation to its transfer agent as evidence of the ownership of the number of shares status on the certificate. Like if any shareholder is having 500 shares, so the series of shares, let's say from share number 1 to 500, it will be mentioned on a stock certificate and along with the name of the owner of the shareholder or owner. Stockholder subsidiary ledger, it's a ledger, it is a record, it shows the number of shares owned by each stockholder. A stock register, it is an independent fiscal agent, usually a large bank retained by a corporation to provide assurance against overissuance of stock certificates. A stock transfer agent, normally it is a bank or a trust company retained by a corporation to maintain its records of capital stock ownership and make transfers from one investment to another, or from one investor to another. A stock transfer agent, it maintains all the records because shares in a day are keep on trading in the stock market and the ownership is keep on changing. So the maintaining the ownership status for the organization, it is done either by a designated bank or any trust company which perform this job for the organization, so that the record will be updated accordingly. The next is about a stock split. Viewers, some good companies such as SpaceX, Microsoft, Facebook, their shares are very expensive. Sometimes some organizations, they split their shares so that their share will become more affordable. Let's assume if a company's share is having value $100 in the market and the small investors cannot think to purchase it because of their expensive price. So the company sometimes split the value of their shares. They will split their shares into two. So $100 share sometimes, let's say if it is split into two, so each share after split will have a value of 50-50. It will not cost any financial loss to the existing shareholders, because the existing shareholders, if they have one share in their possession, in their ownership, now it will become two shares with the same value. But this action will bring down the price of the share in the market and the share will be more affordable to the smaller investors. So this scenario is called as stock split, and normally stock is split, it is mentioned like 2 for 1, like 2 shares for 1 share, or 4 for 1, 4 shares for 1 share. So if the share price is 100, it is split into 2, so the resultant share will be 50-50 values. If it is split 4 for 1, so it will become 25-25 each share, like that. There will be 4 shares of $25. The next concept is about treasury stock. A treasury stock, shares of a corporation stock that have been issued and then reacquired but not cancelled. Some organizations, they will buy back their shares from the market, which doesn't mean that they are cancelled. Why companies they buy their shares from the market? Sometimes they want to reduce the number of shares outstanding in the market, or they feel that the capital which they are using at the moment is more than their requirement, or there are some other reasons. There could be so many reasons. I will cover them in the upcoming videos, and I'll give you a practical demonstration on it as well. So viewers, I hope you would have understood the meaning of these terms, and with the help of these terminologies, you will be able to understand the stockholders equity section of statement of financial position or balance sheet. Thank you for watching. New viewers are requested again to like and share this video and subscribe to Finance Specialist channel by clicking on subscribe button and selecting the select all option, followed by pressing the bell icon to get the notification of upcoming videos. You can share your thoughts and suggestions in the comment section. Stay blessed. Thank you very much.